So you want to own a bank. Owning a bank sounds like the ultimate hustle. People hand you their cash, you loan it out at a markup, you pocket the spread, and life is good. That's the simplified version of banking. What's missing is the price tag behind the scenes, what it actually takes to run one, what happens when the numbers stop cooperating, and why some of the most seasoned people in finance have watched institutions they spent decades building disappear in a single afternoon. What a bank actually is. Forget the image of a bank as a glorified safe, a room where your money sits untouched until you need it. That's a storage locker, not a bank. A real bank is an engine that converts other people's money into income-generating assets. The instant your deposit lands, it goes to work. Picture it like any manufacturing process. A bakery turns flour into bread, a steel mill turns iron into car parts. A bank takes deposits and turns them into loans, bonds, and investments that produce income daily. The raw material is your money. The product being sold is credit. Here's what makes banking fundamentally strange as a business. When a bakery sells a loaf, the flour is used up. When a bank lends out your deposit hasn't disappeared. You can still log in and see the balance, still pull it out tomorrow. Yet the bank has simultaneously handed most of it to someone else. That's not a scam, that's fractional reserve banking, and it underpins every modern economy. The multiplier effect. Here's the mechanics. You put $100 in the bank. The bank doesn't lock all $100 away. It holds back a slice and lends out the rest, betting that everyone won't show up demanding their cash on the same day. For most of U.S. history, the reserve requirement sat at 10%. So of every $100 deposited, $90 could go out as loans. That $90 gets spent, lands in someone else's bank account, and that bank keeps $9 while lending $81, and the chain keeps rolling. One original $100 deposit can eventually ripple out to somewhere between $900 and $1,000 moving through the economy. That's not sleight of hand, it's arithmetic. It's also why an economy can keep issuing credit without physically printing new currency every time someone needs a loan. In March 2020, the Federal Reserve dropped reserve requirements to zero altogether. Banks are no longer legally obligated to hold any fixed percentage in reserve. Instead, the Fed pays interest on reserves banks choose to park with the central bank, nudging them to hold funds voluntarily rather than mandating it. Regulatory attention has since shifted toward capital requirements, which we'll get into, but the underlying principle hasn't changed. Banking runs on trust, on the bet that not everyone asks for their money back simultaneously. When that bet fails, the whole structure buckles. The price of admission. So you want to open a bank, what's it going to cost you? This is where the first surprise hits. You might assume it's just a pile of cash and a nice lobby. In reality, before you've accepted a single deposit or issued a single loan, you've already burned through somewhere between $2 million and $30 million and spent 1 to 3 years buried in paperwork. According to the Federal Reserve, launching a bank means securing approval from at least 2 separate regulators. You need a charter, either federal from the Office of the Comptroller of the Currency or state level, depending on where you're setting up shop. Separately, you need deposit insurance from the FDIC. Both applications demand exhaustive paperwork, your business plan, your leadership team, your risk management framework, capital projections, and background on everyone involved in running the place. The FDIC won't sign off on a bank it doesn't believe can survive, so your pitch has to prove more than just deep pockets. It needs a believable, workable plan. Then there's capital, which is not the same thing as deposits. Deposits are what you owe customers. Capital is money the bank itself owns, the buffer that soaks up losses when things go sideways. Under current Fed rules, large banks need a minimum of 4.5% of risk-weighted assets in capital, plus a buffer of at least 2.5% on top. Smaller community banks are typically expected to maintain a leverage ratio around 9 to 10%. Translation: if you want a community bank capable of issuing $100 million in loans, you need roughly $10 to $15 million of your own money before you even open the doors, and it can't be borrowed or pulled from deposits. It has to be genuinely yours. And that's before leasing office space, hiring anyone building tech infrastructure, buying compliance software, or paying the attorneys who will walk you through the regulatory maze. No loans made yet, no interest collected. You've already spent real money just to get permission to exist. The bills keep coming. Say you're finally open. The expenses are just getting started. People. A working bank needs loan officers, compliance staff, risk managers, branch employees, IT teams, cybersecurity specialists, auditors, and executives. Payroll alone for a small community bank runs into the millions annually. For a large regional bank, it's hundreds of millions. JP Morgan Chase, the biggest bank in the U.S. by assets, reported over $22 billion in non-interest expenses in a single quarter of 2024. That's before counting what it pays depositors in interest. Technology. Banking is about as tech-heavy an industry as exists. Every transaction has to be logged, verified, secured. Fraud never stops. Cyber attacks never stop. A single breach can cost a bank hundreds of millions in fines, legal bills, and lost customers. Big banks now spend billions a year on cybersecurity alone. Compliance. Few industries are regulated as heavily as banking. Anti-money laundering rules, fair lending laws, consumer protection statutes, stress testing mandates, reports go out constantly to multiple agencies. Keeping enough lawyers, auditors, and compliance officers on staff to stay current is one of the biggest line items for large banks. Bad loans. Every loan carries the risk that some of it never comes back. Job losses, failed businesses, a real estate downturn. Banks have to set aside funds in advance for these anticipated losses, called loan loss provisions. In a rough year, these can devour a huge chunk of what would have been profit. Put it together, and it's clear. Long before a bank earns any revenue, it's carrying massive fixed costs that keep running whether or not the loans are performing. Where the money comes from. The core income engine is the net interest margin. Borrow cheap from depositors, lend expensive to borrowers, keep the difference. That spread is the whole business. Savings accounts pay depositors very little. Credit cards charge borrowers a lot. Mortgages currently run 6 to 8% for most buyers. The bank sits in the middle, collecting the gap. A $500 million loan book earning a 3% net interest margin generates $15 million a year before expenses. Subtract payroll, tech, compliance, insurance, deposit costs, and loss provisions, and what's left is actual profit. But lending isn't the only revenue stream. Banks have gotten skilled at monetizing nearly every interaction. Account fees, monthly maintenance charges, wire fees, cashier's check fees, foreign exchange fees. Overdraft fees alone generated close to $10 billion across banks and credit unions in 2022, per the Financial Health Network. A figure regulators increasingly scrutinize as predatory, even though it's remained highly profitable. Then there are interchange fees. Every card swipe triggers a processing fee paid by the merchant, and the bank takes a cut. Across billions of transactions, that adds up fast. Add wealth management fees from advising affluent clients and, for the largest banks, investment banking revenue from helping companies raise capital, advise on mergers, and trade securities. JP Morgan's investment banking revenue jumped 49% in Q4 2024 alone. That year, the bank posted a net profit of $58 billion, the highest annual profit in American banking history. That number only exists because of scale. The margin on any single loan is tiny, but multiplied across trillions in assets, tiny percentages become staggering totals. The double-edged sword, leverage. Here's what makes banking genuinely unlike most other businesses. A restaurant owner puts up their own capital, buys equipment, hopes the food margin covers it. A bank operates almost entirely on other people's money. Deposits are the raw material. You borrow them cheap, lend them dear, and the profit you generate sits on capital that isn't yours. Bankers call this leverage, and it's simultaneously the reason banking can be extraordinarily profitable and extraordinarily dangerous. If a bank earns a 1% return on $500 billion in assets, That's $5 billion. But measured against its actual equity, the capital that truly belongs to the bank, the return on equity might hit 10%, 15%, even 20%. JP Morgan's return on tangible common equity in 2024 was around 22%. Almost no other industry sustains returns like that. But leverage cuts both ways. When asset values drop, loans go bad, bond prices fall, or markets freeze, the losses don't land on depositors first. They hit that thin sliver of equity capital directly. A bank holding $50 billion in deposits against $5 billion in capital only needs to lose that $5 billion, just 10% of what it owes, to become technically insolvent. This is the trap sitting at the heart of banking. The exact mechanism that makes it so lucrative is what makes it capable of collapsing almost overnight. Washington. Mutual, a cautionary tale. Kerry Killinger ran Washington Mutual, WaMu, for 17 years. By 2007, it was the largest savings bank in the country. Over 2,200 branches across 15 states, 43,000 employees, $188 billion in deposits. Killinger built it from a regional player into a national powerhouse. He knew mortgages, he knew retail banking, he knew his customers. WaMu had leaned hard into subprime mortgages, loans to weaker credit borrowers at higher rates to offset the added risk. For years, the extra interest more than covered the extra defaults. Then home prices, which had climbed for years, began falling in 2006. Borrowers who could no longer afford payments had no equity cushion left to sell their way out. Defaults piled up and WaMu's loan book started bleeding value. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy in U.S. history at the time, involving over $600 billion in assets. The shock rippled through markets instantly. WaMu depositors panicked. Over the following 10 days, they pulled $16.7 billion out of the bank, more than 11% of total deposits. The FDIC determined WaMu lacked sufficient funds to keep operating. On September 25, 2008, regulators seized the bank and sold it to JP Morgan Chase for $1.9 billion. A bank holding $188 billion in deposits sold for under $2 billion. Bondholders lost roughly $30 billion. Shareholders lost nearly everything. The real question isn't how WaMu failed. It's how a man who spent 17 years mastering mortgage banking ended up presiding over the largest bank collapse in American history. The answer isn't personal failure, it's structural. The entire American banking system had grown dependent on ever-rising home prices to keep the loan math working. Once prices stopped climbing, that math broke everywhere at once, and when one major player fell, fear spread to every institution, not because they were all failing, but because no one could tell which ones would be next. Silicon Valley Bank, 44 hours. That's the core risk baked into banking. It's not just that loans go bad, it's that confidence itself is fragile. A bank can look perfectly solvent one morning and face a fatal run by the afternoon, without anything in its underlying business actually changing, just because enough people got nervous at once. Silicon Valley Bank held $209 billion in assets as of the end of 2022. It was the 16th largest bank in the U.S., operating for 40 years. It vanished in 44 hours. SVB specialized in serving tech startups and venture capital firms. Between March 2020 and March 2021, its deposits doubled, from $62 billion to $124 billion, as pandemic-era cash flooded into the startup world. SVB parked much of that money in long-term government bonds, which paid better rates than short-term instruments. Nothing reckless there. Government bonds are about as safe as it gets. The issue was duration. Long-term bonds lose value when interest rates climb. When the Fed began hiking rates aggressively in 2022, the fastest pace in 40 years, SVB's bond portfolio's value dropped sharply. By year-end, the bank was sitting on roughly $17 billion in unrealized losses on bonds it had been treating as long-term holds. Meanwhile, the tech sector was contracting. Startups were burning cash and withdrawing funds, shrinking SVB's deposit base at precisely the moment its bond holdings were underwater. On March 8, 2023, SVB announced it had sold $21 billion of its portfolio at a $1.8 billion loss and was scrambling to raise more capital. That announcement lit the fuse. Venture capitalists connected to SVB's client startups started messaging each other. Group chats lit up. Peter Thiel's Founders Fund pulled its money out entirely. Others followed fast. By the close of business on March 9th, customers had tried to withdraw $42 billion in a single day, nearly a quarter of the bank's total deposits. SVB ended up with a negative cash balance of $958 million. It simply couldn't function. On March 10th, California's Department of Financial Protection and Innovation seized the bank, with the FDIC stepping in as receiver. Employees had reportedly received their annual bonuses that same morning, hours before the government took over. What sank SVB wasn't bad loans. It was interest rate risk, the gap between what assets were worth on paper versus in a rising rate environment, combined with a depositor base so tightly networked that panic spread at the speed of a text message. The Fed's own post-mortem, released in April 2023, concluded that SVB's management had mismanaged interest rate risk, its board had failed to provide adequate oversight, and federal supervisors had been too slow acting on warning signs they'd already flagged. The system broke down at every level simultaneously. The variable nobody controls. Picture your own bank, staff hired, loans on the books, fees rolling in, a healthy net interest margin. The numbers look solid on paper. Then interest rates move, and that single variable sits underneath everything else in banking. The Federal Reserve sets the federal funds rate, the overnight rate banks charge each other, which ripples through nearly every other rate in the economy. When it rises, deposit costs rise immediately. When it falls, loan income falls. Banks try to manage this through asset-liability matching, trying to align the time horizon of assets, loans, investments, with the time horizon of liabilities, deposits, borrowed funds. Load up on short-term deposits and pour them into 30-year mortgages, and you're exposed. Rising rates mean your deposit costs jump right away while your mortgage income stays locked in at the old rate. That mismatch isn't always visible. It doesn't always look dangerous. WaMu looked fine until it didn't. SVB looked fine until it didn't. The economics of banking are shaped by decisions made by a committee that meets 8 times a year in Washington and can reshape the entire financial landscape within months. That's the volatility baked into the business. The model works beautifully under the right conditions, but those conditions aren't guaranteed, and they can shift faster than any bank is built to absorb. Running the numbers. Suppose you've done everything by the book. You raised $15 million in starting capital, secured your charter and deposit insurance, opened your doors, and built a $100 million loan portfolio at a 3% net interest margin. That's $3 million a year in interest income before expenses. Add in fee income from accounts, wires, and card processing, and gross revenue reaches $3.7 million. Now subtract payroll for a bare-bones 15-person team, $1.8 million, technology and core banking software, $400,000, compliance and legal, $300,000, FDIC insurance premiums, $80,000, loan loss provisions, $300,000, overhead and physical space, $200,000. Total expenses, roughly $3.08 million. Net profit, around $620,000. At that pace, recouping your $15 million investment takes about 24 years, and that's the good scenario. Now the bad one. Interest rates climb 2 percentage points while half your loan book is locked into fixed rates. Deposit costs rise instantly as customers chase better rates elsewhere. Your net interest margin compresses from 3% to 1.5%. Interest income drops from $3 million to $1.5 million, while expenses stay flat. You're now losing money every month. Or picture a recession instead. Unemployment climbs, defaults pile up, loan loss provisions jump from $300,000 to $1.5 million. Same result, losing money monthly. The swing between a good year and a bad one can be $2 million on a bank this size. That sounds survivable in isolation, but your entire capital cushion is $15 million. Two rough years back to back, and you've burned through 27% of it. Three rough years, and regulators start asking pointed questions. The verdict banking, when it works, is one of the most reliably profitable industries in the history of commerce. JP Morgan pulled in $58 billion in a single year. Europe's wealthiest dynasties chose to own banks rather than factories because they understood something still true today. Sitting in the middle of money flows means collecting a toll on nearly everything the economy does. But banking has also produced more spectacular blow-ups, more catastrophic losses of other people's money, and more government bailouts than nearly any other industry in human history. The reason is always the same. The business runs on leverage, and leverage amplifies everything, the good years and the bad ones alike. And the bad years in banking don't creep up slowly. They show up in 10 days of withdrawals. They show up in 44 hours. They show up the morning a venture capitalist fires off a message to a group chat. WaMu had $188 billion in deposits and was gone in 10 days. SVB had $209 billion in assets and was gone in 44 hours. Both were run by seasoned people who understood the business deeply. Both had weathered previous crises. Both were profitable right up until the moment they weren't. So if you're still set on owning a bank, understand exactly what you'd be buying. Not a vault, not a steady, predictable income stream. You'd be buying a machine that converts trust into money, one that runs entirely on the assumption that the trust never runs dry. The moment it does, no amount of capital moves fast enough to save it.